In this video, we're going to test an entry technique published years ago by Larry Williams, which he calls the OOPS strategy. The idea is based around price gaps between the open of the new day and the previous session or previous day's high or low. I haven't previously looked at this entry technique on the Forex markets because these types of gaps are pretty rare. When we do see these types of gaps, they more often than not happen on a Sunday evening in New York time, because that's when we've got the biggest gaps in the Forex markets, from the close on Friday through to the open of the first session of the week on that Sunday. But I thought it might be interesting to test out, so I quickly ran a test on dollar yen using an end of day exit, and the results were actually much better than I expected. So I decided to make a video about it, and I'm going to test 3 different exits, and I'm going to test it across 14 different Forex pairs. The rules for the strategy are really simple, and I'll show you exactly how to trade it in just a moment. I adjusted the entry order very slightly from Larry's original because I found that we were getting in trades very soon after the market opened, and as Forex traders, you'll probably know that just as the market opens for half hour, sometimes an hour and a half, the spreads can be much wider than what they usually are. And of course, this has a negative effect on our profit. I did some limited testing and I found that using a market order at 18:30, so 90 minutes after the market opens, seemed to have a similar performance in the backtest from using that of Larry's original entry order. But what that allows us to do is it allows us to enter the market when the spreads are much narrower. So although the backtests will look fairly similar, in reality, when we're actually trading, using the market order at 18:30 will be much more profitable. So let me show you how this strategy works, and then we'll see which markets this strategy makes most money in. Let's go through the rules then, and then I'll show you an example on the chart. So trade entries. Number 1, if the open is less than yesterday's low, that means that there's a gap in price, then buy at 18:30 Eastern Standard Time. That's just a market order. And the opposite for a short, if the open is higher than yesterday's high, then sell short at 18:30 Eastern Standard Time. So essentially we're banking on the fact that the price is going to come back within the trading range of that yesterday's bar. Trade exits. These are the different ones that I'm going to be testing. First of all, I'm going to be exiting at the end of the session. When I say the end of the session, I'm actually using 16:30 Eastern Standard Time rather than 1700. I'm doing that just because I'm using a 30-minute chart to run the tests on, and in reality it won't make much difference whether we use 16:30, 16:45, 16:55. So that's the first exit at the end of the session. Second exit, I want to leave the trade running a little bit longer and look at exiting after 3 days. The third exit is after 6 days. And we've got a stop loss, which is a fail-safe, and it's rarely going to be hit, just at 500 pips. We want to see how the strategy works in itself, rather than the stop loss having a big effect on the performance. So that's why I've kept it wide. Of course, I could test any number of days. I could test 2, 3, 4, 5, all the way to 10, 20. But to keep the tests at a minimum, I just decided to go up to 6 days, because I think this pattern is going to be a very short-term pattern. Here's an example on the chart then. We can see that the open of this session was actually less than yesterday's low, so there was a gap to the downside, and then at 18:30 we buy and then exit at the end of the day. I'm using a 30-minute chart here just for testing purposes, so you'll notice these dotted lines, they represent the full session, so this is the full 24 hours of the session. So that's why you can see the entry is on the open of the 4th bar, which is at 18:30. As I already said, the tests are going to be run across 14 different Forex pairs and then collectively as a portfolio. So including 3 different exits, there's 45 tests in total. I'm going to use data to do the testing from Oanda, and it's going to be from January 2008 through to June 2023. And I'm going to use MultiCharts, as always, to run the testing. We're collecting a lot of strategy testing data and putting it together in a database, which we're building together here on YouTube. The intention is to build this reference document or this strategy database so that you guys can have a look and you can see which strategies work on which markets and which strategies don't work on which markets. And of course, I'm giving you all free access to this Forex strategy database. So if you find the link in the description down below, you can go and access that immediately. but make sure you've finished to watch this video first. Okay, let's go and have a look at our first set of test results. Okay, we're in MultiCharts, and I mentioned here's the date range from January 2008 through to June 2023. And here's the 14 Forex pairs we're going to be looking at. And I already mentioned briefly that we're using a 30-minute chart. That's just because the way I've programmed it, that allows me to use that 18:30 as an entry time. Here's the strategy that I've programmed. It's the OOPS strategy, and I've just got one input which I can adjust, and that's literally how many days we stay in the trade. So firstly, we're just going to be looking at staying 1 day in the trade. All the results we're going to see in the report are going to be in pips rather than the currency value. So let's look at the first performance report. So this is the performance for the complete portfolio. So it's making 8,600 pips. That's quite good. If we look at the equity curve, and there's the equity curve. Was working quite well actually as a portfolio up to 2016-ish. Hasn't done so well in recent years. But what we want to see is the individual markets. So straight away we can see that most of these are profitable. In fact, 10 out of the 14 are all profitable. Let's quickly go through some of these in more depth. Australian dollar, US dollar, there's the equity curve. Canadian, Japanese yen, there's the equity curve, not bad. Let's have a look at the size of the average trade. Size of the average trade is almost 17 pips, so that's pretty good. By the time we've paid spreads and commissions, we're still going to have a big chunk of profit there still, so that's pleasing. Euro pound, not making much money. Euro yen is doing pretty well. Average trade, 16 pips again. What's the equity curve like? Equity curve is pretty good. Again, flattening off a little bit in recent years, but before that, it seems pretty consistent. Euro New Zealand is making money. Euro dollar is making money. A similar equity curve, again, not quite as good as before, but flattening off recently. Pound Canadian losing, pound yen is losing, pound dollar is losing, New Zealand Canadian is losing, New Zealand US making a little bit of money, US Canadian making a bit of money, US Swiss franc making a little bit of money, and US Japanese yen making some money with a reasonable equity curve. This was actually working right up until, what's that, September-ish 2021. Been declining just in recent years. What's the average trade like? Yeah, pretty reasonable at 13 pips. So by the time we've taken out costs, we're still going to be profit with this strategy. So straight away, the OOPS pattern is showing some promise. 10 out of those 14 pairs which we tested are positive, and the size of the average trade for quite a short holding period is pretty decent too. The next test is exiting after 3 days in the trade. Let's see if the OOPS entry technique benefits from holding the trade a little bit longer. We'll have a look at those results in just a minute. But first, I want to give you the opportunity to download my 22-page Beat the Markets strategy guidebook, because in there I list out 3 more Forex trading strategies, all with pretty decent backtest results. So if you're struggling to find a strategy which actually works over the long term, then I think you'll find the guidebook pretty useful. And at the moment, if you find the link in the description down below, you can download that absolutely free. For those of you guys who want to take your trading to the next level, you'll probably be interested in my trading course. And in the course, I include 6 more, even better trading strategies. More information about that is also down below. Now let's go and have a look at our next test using the 3-day exit. Okay, now you can see that I've changed the input to exiting after 3 days in the trade. So let's have a look at the results. Net profit, 3,000 pips. That's much less than before using the 1-day exit. The equity curve's definitely worse as well, but let's look at the individual markets. Straight away we can see we've got 5 losing markets this time, not 4. And even the winning markets, this time the best market being Euro Yen. Euro Yen did perform quite well with the 1-day exit as well. But let's go through them. Australian dollar, US dollar is losing money. Canadian, Japanese yen. Equity curve's not great, is it? Euro pound is making a bit of money. Equity curve was working pretty well, but working awfully recently. Euro yen, the best one here, was working pretty well up until 2013-ish, and then essentially it's just gone sideways. Euro New Zealand making a bit of money. Euro dollar again was working very well for a few years and then just gone sideways. Pound Canadian losing money, pound Japanese yen losing money, pound dollar losing money, New Zealand Canadian making a little bit, New Zealand US making a little bit, US dollar Canadian dollar with a better equity curve. What's the average trade like? Average trade of 14 pips. So if you remember, we were getting average trades of 13, 16 pips using the one-day exit. So it looks like holding on for 3 days is not really beneficial. US dollar Japanese yen has got a smaller average trade, and the equity curve is worse than holding for 1 day. So in general, I'd say that the 1 day hold for this strategy is actually better than holding on for 3 days. But I wonder how that compares to holding twice as long. So let's have a look at the results for holding on 6 days. Okay, lastly, you can see that I've changed the exit to a 6-day exit. Looking at the portfolio, net profit in pips is 20,500. That's definitely the best yet. Equity curve is a similar equity curve to the 1 day exit. Looking at the individual markets, like with the 1 day exit, we've got 10 profitable pairs out of the 14, and we've got some pairs with much higher net profits now. Euro New Zealand, look, over 7,000 pips. But let's go through some of these. So Australian dollar, US dollar was making money. Again, equity curves just flattening out in recent years. Canadian Japanese yen, not so good. Euro pound making a bit of money. Euro yen making 5,300 pips, with a fairly flat equity curve for the majority of the test. Euro New Zealand making the most money, with a pretty decent equity curve right up until this point, where it just starts to go a bit wrong. Euro dollar, similar story with the equity curve. Pound Canadian losing money, pound yen losing money, pound dollar losing money, New Zealand dollar, Canadian dollar. And this is almost the opposite now. So the early period was flat, and yet it starts to make money recently. So that's interesting. What's the average trade like? Average trade of 16 pips. So yeah, not bad. Yeah, that's really interesting. New Zealand dollar, US dollar. That must be the most regular equity curve we've seen so far. Still making money. Still making new highs right to the end of the test. So that's pretty good. Got an average trade of a large 24 pips. US dollar Canadian. Equity curve's not that great. US dollar Swiss franc is losing money, and US dollar Japanese yen is making just a little bit of money with a fairly bad equity curve. So that concludes the 45 tests using the 3 different exit types. Well, in general, for such a simple idea, the OOPS entry technique seems to work pretty well. Well, better than I expected anyway. What I would like to try when modifying the strategy is perhaps looking at a custom opening time. So rather than using the open at 1700 or 1705, whichever your broker does, maybe there's an opening time which is more significant. For example, maybe looking at the opening prices of the bar at 2100 hours instead of 1700. So disregarding that whole 4 hours prior to that, just leaving that, and then looking at the price of the open at 2100 compared to the previous session's high and low. That way we might see some bigger gaps, and we might see some more frequent trades too. It's just an idea, but something we did notice in the testing, regardless of what exit technique we were using. It seemed like the strategy performance was degrading as time went on, it seemed like the performance was much better up to, I don't know, 2016-ish, and then the performance did start to get worse as time went on. I don't know the reason for this, but what I did notice was that in the earlier part of the test, when the strategy was performing better, we did see some more trades. Actually, let's quickly go and have a look and I'll show you. So we're just back to the 1-day exit, but that doesn't matter. It's going to be the same on all of the exit durations. And here's the equity curve, which we've already seen. And we've already seen how performance is tailing off somewhat. But let's have a look at the number of trades. Here we go, over the years. This is over the complete portfolio. We'll see that in early years we've got trades every year well over 100, 153, 2010, 144. But then from kind of 2017 to the present day, we seem to have less and less trades. Now, maybe that has an effect on the profitability of the strategy. I'm not too sure, but it is something that I definitely noticed. And we can also see that if we look at some individual markets, like we've already seen, what was actually the best market. Canadian, Japanese yen made the most money. Looking at the equity curve, we can see that performance is definitely flattening off in recent years. And looking at the amount of trades we've got, disregard 2023, we're only halfway through the year, but 2022, 1 trade. In 21, we made 4 trades. Whereas in the early years, I suppose in 9 and 10 we didn't make many, but certainly from 11 through to 16, we were making trades in the double figures quite often. What about US, Japanese yen? Again, we got trades in the double figures through to 2017. From 2017 through to the present day, we've only had a maximum of 8, so the trade opportunities are definitely tailing off. So whatever the reason is, whether it's because there are less trades, the performance does generally seem to be decreasing as time goes on. So just something to bear in mind. Well, that's about all for this video and this test. And as always, I hope you've enjoyed it and I hope you've learned something. If you have, then please give the video a thumbs up. I'm going to go and prepare the next test for the next video, which I hope to see you there. But until then, this is Jared Goodwin, and thank you.